If you have lots of bills to pay and then have to pay taxes, like several people, you would be looking for a way to lower your taxes, or even never pay taxes legally. Smart people know how to avoid paying taxes without breaking the law. It is no secret that most billionaires, like Jeff Bezos and Elon Musk, pay little to no income tax. So you must be wondering what secret knowledge about the tax system they have that you don't. Well, our tax system is a progressive one. That means tax is imposed based on your ability to pay. The lower your income, the lower the taxes you should pay, and vice versa for higher income. The federal government divides your income into chunks called brackets. For example, according to the 2022 federal income tax, if you earn up to $10,275, your tax rate is 10%. But if you earn $539,901 or more, your tax rate will be 37%. So you can see that the higher your income and that of your family, the higher your tax rate. But rich people who understand the tax system know how to play the game and pay little to no taxes. Of course, you can also do the same. Just follow along in this video as I show you how to pay no or very little tax legally. But before we start, I want you to like this video. Also, subscribe to this channel and turn on the notification bell. Watch this video until the end, and do not skip any part, so that you don't miss out the important information that could potentially change your life. Before we go into the secret of getting your tax bills to zero, you need to understand the rules of the rich. First, they endeavor to understand how the tax system works. For example, are you aware that we have more than one type of income for tax purposes? These different types of income have different tax rules governing them. The different income types are earned, passive, and portfolio income. Earned income is the income you earn from your direct efforts. It includes wages from your work, side hustle, or business. It also includes bonuses and tips. The IRS taxes this income at the ordinary income tax rates. Passive income is income earned but not from your direct efforts. It includes real estate rental income, limited partnership income, and other investments where you are not a direct participant. They have different rules, although the ordinary income tax rates affect these. But the deductions on passive income are material and can help lower your taxable income. Portfolio income includes capital gains from sales of assets, including stocks and index funds, along with qualified dividends on those assets. The tax rate for these might depend on the capital gains tax rate or ordinary income tax rate. It's wise to consult your tax advisor for these taxes, as they would advise you on how to use them to lower your taxable income. As for dividends, you can consult Publication 550 on the IRS website that treats investment income and expenses. You can also search for qualified dividend rules on the Google search engine to see the different requirements governing dividends and the tax system. Next, I will describe how to use the capital gains tax rate to your advantage. But before I give that, I want to know from which country you are coming. Also, in the comments section, tell me what subjects you would like me to discuss in my next video. Your comments might just be the next video. Now, let's get back to the video on the capital gains tax rate. Using capital gains to lower taxes can be tricky. This is because capital gains tax differs based on whether the investment is short-term or long-term. If the investment is short-term, less than a year, then the ordinary income tax rate kicks in, which is not what we usually want. But if the investment is long-term, you can take advantage of tax loss harvesting to reduce your tax bill. Most retirees typically take advantage of this. Tax loss harvesting is a process where some investments are sold at a loss to offset some of the realized gains when you sell other investments at a profit. Note that a capital gain is a difference between the cost basis of an investment and the price at which it is sold. For example, if an investment costs $50,000 and it is sold for $55,000, then there is a taxable capital gain of $5,000. For tax loss harvesting to kick in, the investor can sell another investment at a loss. For example, say they had an investment of $30,000 and sold it for $20,000 for a capital loss of $10,000. These capital losses can then be used to offset the gain of $5,000 and can offset the loss against income tax. You can also carry over these losses to offset gains made in future years, thereby reducing the income tax they will pay. In these bearish times, When there are several capital losses in an investment, an investor with a large enough capital loss can end up in the 0% income tax bracket by offsetting capital losses against their income tax rates. To lower your income tax rate, you must also be aware of some capital gains tax rules exceptions. First, the IRS treats collectibles like gold and silver differently. You can increase the cost basis of these metals if you buy them yourself, increasing your net losses if they fall in value. Also, if you hold them on a short-term basis, you are not subject to capital gains tax. Also, if you bought, say, $150,000 worth of gold or silver and then sold them at $130,000, you had a capital loss of $20,000. You can offset these losses against your income tax. As a result, your tax liability will be reduced. You can also add the cost of appraisals to the metal, which increases your capital loss and hence reduces your tax liability. Secondly, the treatment of capital gains between states and the federal government differs. Some states have favorable capital gains tax laws. You can move to states with favorable capital gains laws if you have many investments. These can help lower your income tax rates. You can now see that you can use capital gains income to lower your income tax. The rich use this strategy significantly by raising their portfolio income and taking advantage of capital gain harvesting strategies. But to increase your investment income, you need to invest. So I will now consider ways you can manage your tax bill while working or earning money at a job. The government has provided tax-advantaged accounts for doing this. You can lower your taxable income in two different ways. First, by reducing your burn rate. Your net burn rate is your total income minus expenses. By investing any surplus cash, you can attribute this to deductions you are allowed in a year. But many people don't take advantage of the deductions the IRS allows yearly to lower their tax bills. For a single filer, the standard deduction this year is $12,950, but it is $25,900 for couples filing jointly. If a married couple earns $100,000 a year and removes the deductions, they fall within the 0 to 10% bracket and can pay meager taxes or, coupled with other tax advantages, zero taxes. Tax-advantaged accounts can be excellent tools for lowering taxes. That is what I will discuss next. But before I do, I hope you are enjoying this video. I'd appreciate it if you could take a moment to hit the like button. Your support will enable me to continue producing such useful content. If you have already liked my video and subscribed to my channel, that's awesome. Thank you. Now, let's get back to the video. The second way is through tax-advantaged accounts. You can use an employer-sponsored 401k, solo 401l, self-directed IRA, Roth IRA, or health savings account to lower your taxable income or even bring it down to 0. This gives you an added advantage because, at the same time, you are using these accounts to save for your retirement. In addition, the earnings on these accounts are also tax-free, so you can grow these accounts without worrying about taxes. But these tax-advantaged accounts have limits to prevent abuse. This year's annual limit is $20,500 for a 401k, but those aged 50 and above can make an additional contribution of $6,000. Some people would say that one must pay taxes when withdrawing money from these accounts. However, you can use another strategy called the Roth IRA conversion ladder to sidestep this. The distributions from a Roth IRA have the added advantage of being tax-free. Here's how the Roth IRA conversion ladder works. Using a Roth IRA conversion ladder, money from your tax-advantaged or deferred accounts, including traditional IRA and 401k, can be moved to a Roth IRA without incurring a penalty or tax, even if done before your 59th birthday. The Roth IRA has an additional advantage. With just your Roth IRA, the limit you can contribute each year is $6,000 and $7,000 if you are over 50. But using Roth IRA conversions, you have no limits. Many people who anticipate being in a high tax bracket when they retire have found Roth IRA conversions to be a blessing. It helps them make withdrawals from the retirement account without paying taxes and contribute a large amount of money before they are due for retirement. Therefore, Many investors who have learned about Roth IRA conversions have taken advantage of them early. This is how the Roth IRA conversion ladder works. For example, say you intend to retire at 55 and believe you will need $50,000 a year to live comfortably. Because there is a 5-year waiting period before withdrawals, at age 40, you start building your Roth IRA ladder for $50,000 a year of withdrawals. You do this consistently every year until you are 54 years of age. At that point, you can begin withdrawing $50,000 tax-free and without penalty, even before you reach 60. What's so fascinating about this strategy is that over the 9 years you have contributed to the Roth IRA conversion, your contributions are deducted from your income tax. So, you have the added advantage of using your contributions to lower your yearly income tax. You could fall into the zero tax bracket if your contribution is significant enough. So, that's all for today's video. As always, practicing what you learn is where the advantages come in. If you need help, ask your tax advisor about the concepts described in this video. If you enjoyed this video about lowering your taxable income to zero, give the video a like. Also, subscribe to this channel and hit the notification bell. Watch out for my next video on how to attain financial freedom. I will see you next time. Now, if you want to watch more videos like this, then you need to watch this video right here. This video is one of the best on this channel. You can click on this video to watch further.